Welcome to International Finance lecture number 4. And we're going to go through balance of payments this week, okay? Which is going to be the chapter number 3 of our textbook. And again, lecture note 3 in my sequence, okay? It's balance of payments. Largely, it's going to be about international trade. And it summarizes a country's economic activity, transactions, all those things with other countries. Okay, for example, trade balance, we call it import and export, right? Surpluses and deficits, and foreign direct investments, right? And then portfolio investments, and something called foreign reserves, right? All those things will be discussed. And largely, it's going to be kind of a refresher about your understanding in Macroeconomics 101, okay? And before we go deeper into the textbook, right, let me take you to the current issues going on in global market, okay? Global market. What a dynamic and turbulent period that we are living in right now. Like, this is global economic crisis, like crashing. The whole world seems to be crashing down, okay? Down to the bottom, okay? Where is that bottom? We don't know, okay? Why? Because of the coronavirus 19, right? Corona 19 virus. And nobody wants to travel these days. Nobody wants to meet people face to face because of the concern of infection, right? So the whole business activities are crashing down, okay? So not just the financial market is crashing down, but the real economy is a problem, okay? We don't know how to solve it right now, okay? The crisis that we used to have, like Lehman Brothers crisis 10 years ago or 12 years ago, or East Asian financial crisis, all those things were more about the financial market only, usually, whether it was a bubble or bust kind of things. The real economy was just doing okay, right? But right now, the real economy itself is a problem. And the financial market is responding to it. And there's some chain reaction going on, okay, which exacerbates the situation. Now, having said that, let's see what happened on Sunday, last Sunday, right? By the time you watch this video, this is going to be history, I know. But this is a situation that I can, that we have to digest anyway. Central banker, Mr. Jerome Powell, right? A U.S. central banker, he announced on Sunday, right? Sunday, okay? Don't you go to church? No church, of course, because you don't want to get infected. Number 2, he is, right? The central banker, so he has every reason to work 24/7 like crazy, okay? I hope he is healthy, right? Anyway, he announced, okay, a rescue plan for this economic system, okay, largely monetary policy. And Federal Reserve, they cut rates, which is called the Fed funds rate, down to 0%, okay, from 1 percentage point. And then they are going to launch a massive $700 billion of quantitative easing. What is that about? Okay. By the way, today, Bank of Korea also announced a kind of quantitative easing like this in a lot smaller magnitude, like yeah, we want to check it, right? $50 billion or something, $50 billion, or $40 billion. Okay, so why was he announcing this? Because he wanted to lower down the interest rate somehow, okay? So that it would be easier for people to borrow money, and then they could, how do you say, for businessmen's perspective, or from the supply side perspective, the businessmen could easily raise capital and then do their projects, okay? from the demand side, people could borrow easily, and then they could consume a little more, right? And that kind of things was his idea, I guess, right? This is largely monetary policy because he's pumping the money into the system, okay? Now, what was the response to his announcement, right? The next day, Monday, right? Monday, all red, all over the world, right? What you see is a U.S. market stock index like Dow Jones and then S&P 500, NASDAQ, down by 10 or 12% a day, okay, a day. How terrible is that? Well, 1.5 percentage point up or down, okay, for market index, no surprise. But because that's one standard deviation of daily returns. But this is like more than 7 times standard deviation, okay? So extreme events, extreme return was going on. We call it market crash, right? And then if you look at European market, situation was quite similar. And then Asia all the way down, yeah, no good news, right? Rather, the market was not, how do you say, happy enough, okay, or soothed enough with the Jerome Powell's announcement, okay? Why is that the case? Well, because what the market and then the economy needs is not really monetary policy, then not much of a monetary policy, then as much as of a fiscal policy. Fiscal policy is what they want. Fiscal stimulus, right? Give me the money immediately instead of lowering the interest rate, which is rather indirect. Okay, so that's the idea. Now, if you look at Fed funds rate, I'm going to spend some time about the Fed funds rate and then the risk-free rate or U.S. Treasury kind of things to talk about the central banks, right? And then I'm going to contrast this with the U.S. Treasury, okay? The Fed funds rate is what Jerome Powell said that we are going to target this Fed funds rate to 0%, okay? What is a Fed funds rate, okay? Is that 1 month U.S. Treasury bill? And the answer is no, okay? The answer is no. If you look at, let's see, the banking structure, okay, some of you who already took the depository institution class, you can skip about 5 to 10 minutes of this lecture, okay? But let's see. Here's what I understand, okay? Fed funds rate, what is that? Now, here we have a central bank, okay? Why do I draw a bald eagle? Well, that's because U.S. Federal Reserve, the U.S. Central Bank, the statue they have on the building is a bald eagle, okay? Right? And then they look at like this, Federal Reserve Bank, right? So this is a central bank of the United States, right? And then, what is this central bank doing? They work as a lender of last resort to other, to depository institutions, for example, some commercial banks and retail banks. Let's say Bank of America, or Citibank, okay? Or Goldman Sachs, right? Or other commercial banks or depository institutions, right? The thing is, for the depository institutions, well, they must have some balance sheets, right? They must have their own balance sheets, right? What would they have? Shall I draw it over here on top? Their balance sheets, their debt, okay, or the liabilities would be their deposits from you and me, individuals or corporations, right? So there comes a lot of people walking in, hello, and then walk, and go there with their money, put their deposit over there, okay? They get cash out of it, right? But with this deposit, let's say, totally, I mean, their deposit amount is like $100 million, right? With this money, what do? Bankers, right? Do business, invest. You got cash, 100 million, but don't let it sit over there. Okay, you invest this amount in the form of lending, corporate lending. Lend it to any companies or individuals who want to do business. So lending, how much? If you have $100 million of deposit, would you exhaust your deposit amount, okay, 100% of it, okay? The answer is no. Okay, the answer is no. By the way, why is this deposit recognized as liabilities is the first question. From individual's perspective, for this guy like you and me, my deposit is my asset, okay? But the balance sheet or legit, what's that? From my perspective, this is asset, but from the banker's perspective, this is their liabilities. Because at any time, if I go to the bank and say, give me my deposit money, $1 million, please, and they have the obligation to pay me $1 million, right? It's demand deposits. That's why it is recognized as deposit over there, okay? And then with this one, they have to, they're going to do lend to any companies and individuals. And then what is important is that they have to keep a certain amount as a reserve, okay? Let's say 10% of them, which is 1 million, okay? 10%. According to the reserve requirement regulation by the central bank, okay? Why? Because what if they exhaust all $100 million of deposit to corporate lending, that is, you're going to receive that repayment 10 years down the road, but not immediately, okay? So you'd have zero cash, everything over there, okay? You're in trouble because you don't know how many of your depositors will come back to you and say, give me my money, right? That's scary. So you will have to keep a certain amount, minimum amount at least, in your vault or safe, right? So that you will be able to pay them, your deposit clients, right? So that's reserve, okay? That's reserve amount. Now, so where do you keep this reserve, legally required reserve, okay? Well, none other than this Federal Reserve, the central bank, okay? They keep those reserves, okay? So that the central bankers, those supervisors, okay, will be fully in control of these kind of lending institutions, right? Now, not only these guys, but also, what is that? Not only Bank of America, but also Citibank. Let me place this one over here. Citibank, our red umbrella. They also have some reserves, and then Goldman Sachs, right? They should also have some reserves over there, okay, depending on their deposit amounts. Make sense? Okay, deposit amounts. So they all have their reserves kept over there. The thing is, there are many different deposit institutions. In US, literally more than 2,000 or something, 2,000 different banks are there, right? They have those reserves over there. And then day by day, the amount of deposit fluctuates, and then the reserve amount, okay, the actual reserve they have, the cash or the available for them versus the required reserve, okay, may differ, So some of them may have excess reserve, and some other of them may have, let me state it here. Some of the institutions may have excess reserve, and let me put it this way, excess reserve, okay? Like Bank of America, where I used to work before, and Citibank, let's say, they have a shortage of reserve at some point in time, right? And then the shortage or excess may come and go in daily basis, okay? Come and go, shortages and excesses. Then what do? Well, the bankers on these two banks, right, call each other, and you know what? I need some X amount of money for my reserve, okay? Could you lend me some of them using your excess reserve, right? Then the other bankers will say, yeah, of course, it's all over there. I'm going to lend you, but it's not for free. Of course, this is banking industry. I got to charge you some interest, okay? That interest rate, very overnight interest rate, short term, right, based on this reserve. Among these bankers, right, that's called Fed funds rate. Fed funds rate. Make sense? Right? So Fed funds rate, yeah, overnight, kind of very short period of time, lending and borrowing among these depository institutions based on their reserves, excess reserve or shortage of reserves, right? So that's Fed funds reserve, Fed funds rate. That's the Jerome Powell is targeting to lower down to 0%. Okay? So if that is the case, if it is this, the U.S. Treasury that we are talking about as a risk-free rate in corporate finance, U.S. Treasury, okay? If you remember about your Finance 101 or 102, right? There was 1 month or 3 months T-bill rate kind of things as your risk-free rate. You remember that? And based on this, you added beta and then RM minus RF to get to your cost of equity. Remember that, CAPM? Okay, this was your starting point. Jerome Powell, is he operating this one? Okay, and the answer is no. Okay, and the answer is no. U.S. Treasury is Treasury, Fed funds is Fed funds, but it is closely related in the short-term borrowing market in the sense that they are risk-free, backed by U.S. government. I mean, it's essentially U.S. government and U.S. central bank anyway. So they are closely related, but this is not really exactly what Jerome Powell is working on. Okay, this is the one, and that he is not directly touching in this, but he can only, target it. Okay, why? Because this Fed funds market has to be, their own private market kind of things. Market mechanism has to be there. Okay, the central government doesn't want to, or central bank doesn't want to direct and pinpoint 0.0%. No. Okay, you want it to be private transaction. Okay, so that's why. Now, having said that, is there any rate that the central bank can specifically designate and say pinpoint X% in lending to your bank? Okay? Actually, there is such a lending rate that the central bankers pinpoint and order it, right? What kind of interest rate? Something called discount rate. discount rate. Okay. What is this about? Well, here, let's say, can I erase this one? Yeah. All right. Let's say here is a poor, unfortunate bank. Okay, that is about to, is having very difficult time. Somehow their balance sheet is screwed because they lend to a wrong company which was going bankrupt. Okay, and then their balance sheet. I mean, they're in trouble. The bank is in trouble, and then now their depositors. Okay, depositors, one after another. Okay, so many of them run to this, not run really, but they come and say what? I want my deposit money back, my precious money. Okay, this bank will be in even more trouble. Okay, then what do? This banker over here. Okay, let's see this guy. Okay, with a hat. He has to go to central bank and ask in a discount window. And here is a central banker and say, here you are. Okay, central banker will give money to them, like a very short interval. Okay, as a rescue. This is called discount window borrowing, which is different from Fed funds market. Remember, Fed funds was about the healthy banks. Okay, naturally the rate will be the lowest possible. Whereas discount window is about troubled bank, risky bank. The lending rate, discount rate will be higher than that Fed funds rates, right? Make sense? Right. And discount rate is about this discount window borrowing and lending. Okay, this lending, the rate is specified by the Fed officials, right? So that's one distinction you want to make. Okay, I'm going to ask you in the exam setting. Now, the next distinction I want you to make is a treasury. Okay. What is this about? Okay, for that purpose, let me shrink this window a little bit and then go further over here, and then first finish the discussion of Fed funds rate history. Okay, then move down to the Treasury rate. Okay, Fed funds rate historically over the last about 20 years, right? It used to be like that, as you see in this line graph. Okay, in 2008, okay, during that subprime mortgage financial crisis, the Fed funds rate went down to 0%, and then it lasted for more than 5 or 6 years. And only recently, the Fed funds rate, target rate, increased, okay, to positive numbers, right? Why? Because there was some, expansion of this economy, and then the overheating is not good, so the central bankers were, increasing this rate somehow. Now, but then again, quite recently, due to the virus concern, okay, the central bankers were targeting the rate to 0 very drastically. And then here what you see is U.S. Treasury yield curve. Okay, some of you who have taken investment class investments or intermediate investments must be familiar with this one. Okay, yield curve. What is that? Well, this is about U.S. Treasury or any governments, for example, government's Treasury bond interest rate. Okay, and then basically it's the yield to maturity of those securities with specified maturity. What you see on the vertical axis is the expected return or yield, right? And then yield to maturity. And then what you see on the horizontal axis is their maturity, okay? From 1 month, and then 2 months and 3 months, all the way down to 30 years, okay, 30 years, right? Wow. To have 30 years of maturity treasury, right, you need to have a very stable financial system that could last 30 years in a predictable manner. Korea used to have only 3 years maturity when I was in your age. Nowadays, 10 years or more is available as the Korean financial market gets mature. Anyway, the important thing is Jerome Powell, okay, what you see is the yield curve before Jerome Powell's announcement and after Jerome Powell's announcement, okay? How did his announcement affect the yield curve is very interesting thing. How did it affect the short-term treasury rate, okay, 1 month treasury rate? Right, so if you look at the 1 month treasury rate, okay, even though Jerome Powell announced that he's targeting at 0% rate for Fed funds, right? It didn't really mean 0% interest rate for 1 month treasury rate. And you see, after the announcement, okay, the rate did not go down to 0 yet, okay? Of course, this is longer term maturity, whereas Fed funds rate is really like a overnight borrowing rate, of course, right? But at the same time, what you need to pay attention to is that his monetary policy, typical monetary policy, okay, it takes place in the open market. Open market, what do you mean? The open market of U.S. Treasuries, bought and sold, okay, bought and sold. And then it is more short term, okay? They're open markets of buying and selling U.S. Treasuries. Central banks get in there for the shorter term maturity U.S. Treasury bank, okay? And then influence this short term loan, short term Treasury rates or Fed funds rates directly targeting like that, okay? Longer term maturities like more than 1 years, right? Their influence used to be very minimal, okay? Their open market operations has been focused on shorter term. Now, quantitative easing is about longer term bond maturity, okay? Longer term maturity bonds in the U.S. Treasury, okay? So $700 billion he announced, right? That they're going to, what do you say? Purchase, right? Which means the bonds, okay, they suck up. Instead, they are pushing all those cash or money, okay, money supply increases. Bond price, okay, increases because the bond gets rarer as the central bank sucks up from the market, okay? Bond price increases, but that yield goes down because there's inverse relation between this bond price and yield. Okay, that's precisely what you see in this change in yield curve. The yield curve before the announcement is like what you see on this, how do you say, gray line? Okay, thin gray line, whereas the yield curve after the announcement is like red line. Okay, now Treasury, how is that different? Okay, how is that different? This is, okay, 재무부 in Korean terminology, or Ministry of Finance, or Ministry of Economics and Finance in Korea. Okay, in the U.S., it looks like the building looks like this. Okay, like Greek style building, I guess. Right, Treasury. Okay. Now, what do they do? Well, basically what they do is public policy, okay, for the whole country, okay, building bridges or some building social infrastructure, all those kind of things, should be their job, okay, with what? With taxpayers' money, of course, okay. So taxes collected, okay, taxes collected, and they basically Treasury is the one in charge of that, right? And but with this money, what do? Well, they bring this money to central bank, the central bank, and say what? Let me erase this part, right? Central bank's balance sheet. Every entities have a balance sheet, right? So they have deposits from the Treasury. Okay. Now Treasury puts their money. Okay, this is their liabilities. Based on this money, okay, central banks can do their own monetary policy or print monies and those kind of things, right? And then the money printed is just a banknote based on this, okay? And then the banknote turns out to be another kinds of liabilities over there. That's not an important thing right now. Of course, some part of it they will have cash in the central bank, but sometimes they have a lot of money left over. What do they do with it? Well, they can invest in treasuries. Treasuries. Securities. Okay. Certain amount of dollars. What? What do you mean? Treasury was here, but why does it sit over there? What I'm saying is, the central banks buys the treasury securities issued by, let's say this is T-bill, issued by U.S. Treasury, and they purchase it with their and then keep it in their balance sheet. Okay. U.S. Treasury, they also have their own balance sheet. Okay. What kind? Well, for them, the Treasury bill, Treasury bill should be their liabilities. Treasury bond, Treasury notes, notes, Treasury bonds, right? Whatever. Why? Why is that the case? Well, think about the situation when they build bridges, like the era of FDR. What's that? The Franklin Delano Roosevelt, right? Building bridges to stimulate the economy, right? Building bridges and some kind of infrastructure. That's a fixed asset. Build bridges. Okay, fixed asset has to be over there. Okay, and then you need to finance. Okay, you need to raise capital to build bridges. Okay, you cannot build it out of nothing. Okay, how? Borrow money from the investors. Okay, borrow money, but by issuing bonds, the government bonds. Okay, the bonds, that's this part. Okay. So issuing bonds, that's good, but who's going to buy that? Well, these banks that I explained before, right? Do you see them in the picture? Let me adjust this a little bit. Okay, like this. Oh my God. Okay, good. Now, U.S. Treasury, right? When they build bridges, they issue bonds, U.S. Treasury bonds, IOU. You, whom? These banks or rich people, Warren Buffett kind of guys, so they buy bonds when they issue. I'm going to draw a line like this. Many securities pieces, Some Treasury bonds go to these banks all down there. They invest in this treasury bond, and then this is an open market. They can trade. The treasury bill could be 1 month maturity or all the way down to 30 years maturity. You know that, right? And then central bank sometimes get in there, especially in the short-term maturity treasury bond market, and then to implement the monetary policy. Make sense? To influence, increase or decrease the borrowing rate, risk-free rate. That's called the open market operations. And usually in the short-term maturity, I said, Now, quantitative easing is about longer term maturity. For this one, I told you about it before. And then now, the interesting thing is, the United States almost had no central banks before 1913. Okay, before 1913. Well, who cares, you may say, but this is very interesting phenomenon, interesting history, right? Bank of England has been there ever since, like, I don't know, like 500 years ago. Bank of Netherlands has been there like even longer time. But the United States, right, did not have central banks. Okay, why is that the case? Why was that the case? Okay, the thing is, it goes back to their history of establishment of this country, right? Independence, okay, Declaration of Independence, and then the founding fathers of the United States hated the concentration of powers, right? Remember, they are the ones who left old European absolute monarchs, right? So that they were believing in, themselves, like, we are doing economic and democratic experiments in this new world, okay? New world. We are bringing those Greek and Roman empires, philosophy and all those science and all those things, but we are transplanting it in cross-Atlantic with democratic ideas. And then we don't want old European style of absolute power, okay? The thing is, absolute power corrupts absolutely. That's what we experienced long before. We hate that, they said. So something in this American continent has to be devoid of this kind of concentration of power. Okay. Now, so that's why they prevented the centralization of money. Okay, because money means power, and then if money gets concentrated in the name of central bank, it will create. They were afraid that it will create some absolute power that would be corrupted. Okay, economic power, right? And together with it, they had the philosophy of laissez-faire, running laissez-faire market system. Okay, we don't want government intervention. Okay, let the market determine through the price mechanism in a most efficient manner. Okay, so that the market will allocate the resource in most what's most efficient manner, which is believing in the invisible hand. Okay, original thoughts were very sound over there, right? So what was the consequence? Well, tens of thousands of small banks emerged in that American continent. Banking naturally springs up as any people make money by doing their day-to-day business. Okay, oil business, you earn money, you got excess cash. What do? Well, start banking. Okay, who is that? The Rockefeller family started their own banking, and then all different kinds of families, they had their own banking system. Banking is going on. Okay. The interesting thing is there has been like tens of thousands of different banks in the United States. And then each created their own paper currencies before the Civil War. Okay, for example, they say more than 10,000 different kinds of paper currencies were available in that continent. Okay, the thing is, as you let the market go on, okay, without government intervention, what happens? Well, money begets money, right? The more efficient one takes over less efficient one. M&A takes places, right? And their power gets concentrated very naturally. Okay, just leave it untouched, and naturally the monopoly powers generates itself. Okay, J.P. Morgan, right, emerged as almost monopolistic power in finance. Now, another thing about this laissez-faire policy, right, about the market, is that left untouched, then the economy experiences boom and bust cycle to the extreme degrees. Okay, and then The government intervention is not there. So what happened was like especially in the bust time or panic time, a lot of people ran to the bank. The bank runs happened very frequently. And then, I mean, the recession or this kind of bust happened almost every 3 to 5 years, right? In the 19th century. Okay. So that was very devastating to the whole country. Okay. Destabilizing the economic system, which was no good because you make this kind of bust makes poor people even poorer, rich people even richer. And then you don't want that kind of social unrest happening. Okay, but that was what was happening in late 19th century United States. It's like a jungle, okay, without anybody in control. I mean, without any government control, right? And bank runs, okay. What is bank runs? That's the thing that I explained before. Poor banks over there, in, for example, 1906, there was a one of the banks in the United States that invested heavily in a troubled company in San Francisco. When their balance sheet of lending goes to toilet, like it goes to rotten, okay, with this wrong investment, their depositors get worried. Oh, the bank seems to be insolvent. I want my precious money back before any other people pull their money out. So I run to the bank and say, give me my money, but I'm not the only one. Okay, you are not alone in capital market, right? Yes. So everybody runs to the bank, and then the bank, even if the bank was actually solvent, if 100% of their depositors run to the bank and try to grab whatever cash they have, the bank will fail. Okay, the bank will fail. One after another, the bank fails, and the next consequence is that some banks, right, in the same lending network, would get affected. There will be domino effect going on because lending to a certain company does not happen in a single basis. Group of friend banks join the party and then lend the money together as a syndicate, right? Syndication loan. And one big company gets screwed up, the banks in the network get screwed up, and then that kind of things, right? Even if any bank is not in that kind of network, but people, they don't know precisely which bank is in trouble, okay? Which bank is in that network. So they spread rumors or fake news. Oh, Bank ABC seem to be in trouble. Let's pull our money back over there. And then even if the Bank ABC is solvent, they go for they really fail. Okay, that kind of rumor has self-fulfilling powers like that, self-fulfilling prophecies kind of things. Now, what's the impact after the domino? I mean, with the domino of bank failures, financial crisis, full-blown crisis really happens. Okay, I hope that kind of situation does not happen this time. Okay, it's going to be all right. Okay, the banking system is all right. That's good part of it. Okay, in this coronavirus situation, but 100 years ago that was a very big problem, especially because there was no central bank. Okay, and then economic depression happens. Well, and then interesting thing is this: in 1907, with that panic, right? There was depression associated with that San Francisco company in 1906 or something. J.P. Morgan, okay, monopolistic banker at that time, essentially worked like a central banker. Okay, of course, I told you there's thousands of banks over there, but in Wall Street, okay, in that Wall Street or New York City, J.P. Morgan was the most powerful guy over there. Okay, and what did he do to prevent the domino effect of bank runs to next company, next bank, and next bank, and next bank? He gathered those bankers and then creditors together and said, "What? These banks are solvent, so don't worry. Those banks, you're in trouble. Go to hell." Okay. So J.P. Morgan was the one who was essentially cutting those domino effect and then controlling all this system. Okay, a single person doing this kind of job for the whole country, whole continent, right? Which was quite ironic. Luckily, he saved the system, but the people who watched that situation realized that what are we doing here? Isn't it the situation that we really wanted to prevent before? Okay, isn't it the reason that we try to avoid any central bankers, right? But we all essentially created one. So instead of leaving it to the human being, why don't we institutionalize into a system so that it will be much more reliable, and then it will be sustaining into the long future. Okay, that was the idea of Paul Warburg and his gangs, right? And then the commercial banks, right? Here's the idea that they figured out in Aldrich committee or something, or they were taking a vacation in a very secret place like Jekyll Island in southern part of United States. Okay, so there the idea was like this. Okay, let's create some central bank. Okay, a kind of central bank, and there the structure will be like this. The commercial banks will be the shareholder of the central bank. See this commercial banks, and then let them be the equity holder. Okay, you see equity of central bank balance sheet. Okay, central bank balance sheet, equity holder. Let them be the equity holders. Okay, chip in certain amount and you become the shareholders, and then influence the control of this central bank somehow. Okay, but there are too many of them, so essentially it's going to be hard to control. Any single guy could control, right? Anyway, and then they wanted to say, we want this central bank to be independent from the government or Treasury. Okay, independence from the central government is very important. Why is that the case? Well, the central government, the administration, for example, Trump or Obama or Clinton kind of guys, Bush, all these guys, right? Or Moon Jae-in 정권 or whatever, like 김대중 정권 or whatever 정권, right? Their administration is dependent on the votings of the general public. And then what they want to deliver to the general public is GDP growth. Oh, during my days of administration, Trump administration, they want to say their economy, GDP grew like fantastic rate, right? For that part, what can go wrong to the central banks, right? Central banks can print money, okay? They print money, or they can stop, right? But if the central bank is under control, and then if the central bank is not independent, okay, of the government, then the government can say, well, these days real GDP growth is very terrible, but let's create some nominal GDP growth by printing money. You print money for me, and create some artificial growth in economics. Okay, that's creating another instability to the system. So they wanted to stay away from this kind of influence. Okay, and then host government's deposits that come from tax revenues. I told you before, the tax revenues collected by treasuries or IRS, that goes into this guy's deposit, right? And then they can print money, okay, on their own, okay, for the whole country. That was their idea. And then central bank's role over here, you see over here with the bald eagle over there, right, that I drew, okay. Now, the central bank, Federal Reserve Board, accordingly, was born in 1913. So it took about 5 to 6 years ever since that the J.P. Morgan's influence, single like a Lord of the Ring kind of situation, right? You want to be the Lord of the Ring? He once was, right? but Federal Reserve, right, 1913. 12 different Federal Reserve banks were created. Okay, Minneapolis is one of them in Northwest, and then New York and San Francisco, all regional centers of economic activities, right? Why not create just one central bank like Bank of Korea or Bank of China? Again, they don't want a centralized monetary power, but let's decentralize it. That philosophy still sustains over there. Now, this Federal Reserve Bank, right, and especially the top organization is Federal Reserve Board, is a decision-making group, right? And Powell, Mr. Powell is the chairman of this board. Now, monetary policy is something they implement for the whole country. Money supply, should they increase or decrease? Okay, expansionary or contractionary kind of things they implement. And then they try to help financial stability, because, as I said before, financial instability creates social unrest, like toppling the government and then total chaos. You don't want that kind of things happening, right? And the central banks works as a lender of last resort. I told you about this discount window borrowing over there. Hey, mister, right? That kind of things. Now, for monetary policy, the purpose is pursuing price stability, okay? Inflation, right? You don't want hyperinflation. You don't want deflation, okay? It's even more spooky, right? And then, are we going to that kind of deflationary pressure? Maybe these days, we don't know, okay? The economic activity is really, really contracting. It's a total shock. So we have to be careful about that. But that kind of thing is something the central bankers want to avoid, okay? And a reasonable degree of inflation, they want to have it over there. At the same time, they want to maximize the employment, okay? Maximize employment for, otherwise there are going to be a lot of social unrest going on. And then why is it, interesting thing about the US system is that they declare these two objectives, creating, pursuing price stability and maximizing unemployment. Maximizing employment, come on, right? Maximizing employment, okay? Now, why is that the case? Well, sometimes if you pursue maximum employment only, you want to heat up the economy too much. Boom, 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 boom only, which will create a lot of inflation, high inflation rate, okay? And price gets unstable over time. You don't want that happening. So you want to cool down the economy and lower down the inflation rate, but that kind of cooling policies may shrink down the employment so that the unemployment rate may shoot up. You don't want that to happen either. So striking the balance is always a difficult job for the central bankers. Now, how do they implement this kind of monetary policy? I told you before, open market operations, right? In bond market over there, right? Bond market, US Treasury. If the central bank buys US Treasuries, then bond price increases because the demand increases and the bond price increases. And then that means inverse relation with the risk-free rate, so that the risk-free rate goes down. Okay, the interest rate goes down and Fed funds rate goes down, and that encourages the business. Okay, essentially buying securities means like pushing out the money, the cash or the money, so supplying the money, and then expansion of the whole economy. Selling treasury securities the other way around. So selling treasury securities out of their balance sheet. Here's US Treasury that I purchased before. I want to sell it, okay? Which means I want your cash back from the system. Less cash available, okay, contractionary. And then what happens to this bond price simultaneously is that bond price goes down because there's supply, excess supply of bonds, securities there, right? Bond price goes down, which means the risk-free rate goes up, interest rate goes up, because there is an inverse relation between the value of the bond and then the discount rate. And together with it, Fed funds rate target increases, right, to cool down the economics and the inflation. Now, that's basically it for central bank and the Treasury. You can distinguish these two. And then you're in Korea. For some of you, foreign students, right? Welcome to Korea. And you should see the Korean central bank, right? And then Korean Ministry of Finance, which is Treasury. And you see this top building is Bank of Korea. Was built about 100 years ago when there was Japanese invasion under Japanese Empire. And then nowadays the building is used as a museum of money. Okay, and then the building behind it, okay, modern building behind it is really the recent Central Bank of Korea or Bank of Korea. Treasury or 기획재정부, right, is in the city of 세종시, which is about 2 hours away from here. Okay, the southern why did they move to 세종시? I don't know. Like they wanted to decentralize all these facilities. Okay, now so that's that. Having said something about Bank of Korea, well, the U.S. and then the rest of the countries maybe, or other countries, including Korea, they work together, okay, in a coordinated manner because the global capital market is so well connected and they want to go hand in hand. And basically the economic business cycle goes pretty much together, right? And then, especially these days, coronavirus, we are sharing everything, okay? So, stimulating those economy, well, following the U.S. Case, right? The central banker of Korea just lowered down their interest rate to 0.75 percentage point. Okay, the other day, as you see in this graph, benchmark rate cut to record like this was reported in a newspaper, and then this one, base rate in Korea, is kind of different from Fed funds rate. This is more like a repo rate, okay, something called repurchase agreement, okay, that's going to be a part of your homework later on. What is repo rate, okay, repurchase agreement, okay, that rate is, determined by the central bank in Korea, okay. Now, after this, right, after the Jerome Powell's announcement, I was feeling, and not only me, but many of the economists felt that not enough, right? Because, as I said before, that's monetary policy only. What the economy needs is fiscal stimulus, okay? Fiscal policy. In this picture, okay? Monetary policy is about this ego, central bank. And then fiscal policy is about the Treasury, okay, the government, the administration, the budget, government budget issue, okay. They need to do something about it, okay, instead of this guy pumping money into the system or not, okay. This guy doing is a lot different, okay. What is it? Directly doing some projects or doing something to the people and giving money directly to them, okay. The thing is, right now, the coronavirus hit both the business people and then the people in the production side and people in the consumption side. Okay? They don't have money and they can't go out, okay, and consume at all. Now, those companies, some of them or many of them, still need to pay their immediate debt, short-term maturity debt. The business people, they have to repay that because money never sleeps, right? So, fiscal policy. Why don't you help those small companies that is in need of this repayment of debt? Help them out, okay? That was what Greg Mankiw was arguing about. Okay, Mankiw rather said give $1,000 to each individual in the United States so that they can spend and help those people in the business somehow. Okay, so that was what Jerome Powell was not able to address anything. So that's why the stock price plunged like 10% or more. Okay, even after that announcement. Then the night after, what happened is that Steve Mnuchin of U.S. Treasury, this guy over here, announced it with Donald Trump and saying that we're going to do a stimulus package, monetary policy. Here you go, $1,000 or more, okay? And then we're going to buy those commercial papers from those businesses in distress, right? Commercial paper means like IOU within like 3 months or 1 month or something. Corporate IOUs, okay? You have debt burden maturing right now. Give it to me. I'm going to take care of it, okay? So kind of Superman approach, taking care of it. That's good, okay? So afterwards, there was after the announcement of the Mnuchin, there was 5% up, okay, in the stock price on the next day, right? Or on the very day, 5% up after 12% plunging. That's not fully recovering, okay? It was a good policy, but it's not to the full. Why is that the case? Because we have still uncertainty, huge uncertainty going on. Next is the a piece of news about exchange rates. Okay, if you look at the Bloomberg news, and there was an article saying that surging U.S. dollars is next big headache for world economy. Okay, and then the CNBC commonly reported that sterling falls to levels not seen since 2016 as dollar strength hammers global currency. What? Sterling? What the heck is that? Some of you may say that's British pound. Okay, sterling. British pound? How could it be? Okay. US dollar is such a dominant currency, and this is for, I mean, when this kind of crisis happens, people run for safe asset. We say flight for safety. And then the utmost safe asset these days is US dollars, because 70% of our FX market or global transactions is done with US dollars, as you all know, right? And that's why. It's like 100 years ago's gold kind of things. So they have to run for it. And if you look at the exchange rate, okay, relative exchange rate with respect to dollars, this is what you can see. The change year to date in the strength of each country's currency against the dollar. So 0 is the benchmark point. January 1st of January or something, right? Let's put it as a benchmark point where your currency versus dollar rate is put as 0, okay, benchmark. And then how did this one, your currency, for example, Korean won, performed in exchange market, for the spot exchange market with respect to dollars. So let's see, Korea, the red, dark red over here, this one, okay? This is Korea. And another red is Australia, which is this red below, okay? And then some others like Euro, they are staying in par, right? People seem to be pretty much equating dollars and euros. They are equally safe assets, but the rest of the currencies are in trouble. UK, where are you, UK? British pound over here, the dark navy color over here, okay? And then Russia and Mexico going to toilet, okay? This is diarrhea time for, smaller currencies, as well as big currencies like British pounds. Very, very surprising time. And then having said something about currencies, FX rate in the spot market, let's take a look at currency charts over here in the web page. Okay, I'm going to take you to, let's see, Jerome Powell, right? XE, GBP, right? Currency charts, right? This is a web page that you can play with, right? There you specify the currency to US dollars or US dollars to your currency, right? So what do we see? Well, 1 British pound is about nowadays 1.15 US dollars worth, right? And then what did we see? Australian dollars, can we see it? Australian dollars. Let's go. Okay. 1 Australian dollars is now 0.57 US dollars. Okay. Can we expand this chart a bit? Yeah, like this. Now, how about Korean won? 대한민국. Yes, over here. So 1 Korean won is about very, very, very low cent of US dollars. How many zeros, right? 3 zeros. So this one is straining your eyes. So in this case, you have to change the position over here. So US dollar versus Korean won. Right? And you can see at least the value of Korean won is going down just like other currencies, right? And here in the Korean won to US dollars, you flip it, okay? And you see the US dollar price, it has been increasing like crazy these days due to the coronavirus crisis, right? And then you can expand the graph like this, your timeline, okay? 10 years, you can compare it. So now, today, the exchange rate of Korea, right, was like $1 US dollars was like above 1,300 Korean won, okay, that you see over here. Is it historic high? And the answer is no, not yet, okay? In 1997, okay, during the financial crisis in East Asia, it shot up to like $1 was like a 1900 won or something, 1900 and above, okay? Why was that the case? In 1997, we did not have enough currency reserves, US dollar reserves, okay? These days we have enough of it, so we don't have to worry about that kind of situation yet. And then the government budget deficit is still good, and the debt maturity structure seems to be still okay in Korea. So we don't need to worry about it that much. And as you've seen before in this chart, the Korean currency is relatively performing okay, compared to other currencies like British pound or Australian dollars, right? Korean won is over here, the other currencies are over there, okay? So that's that. Now, in talking about 1997, when we Koreans or Korean government is declared bankruptcy or like the default, right? We got the help from IMF, the IMF, right? The IMF. Always the is a difficult part for Koreans to speak in English. But anyway, IMF was helping, okay, Korea. And then this year, as coronavirus hits the world, and IMF announces this, right? If you look at their news article, they say, well, don't worry, $50 billion, we're going to help you guys. Any countries that needs this kind of rescue plan, please tell us, right? $50 billion worth, okay? That's their rescue package size, okay? Is this big enough? Is still another question, because if you look at the fiscal stimuli program of U.S. government, it was like $1 trillion, okay, as opposed to $50 billion. Of course, fiscal policy is different from this kind of monetary help or something like that, but still the size itself is different, right? And then some of you may wonder, IMF, right, the International Monetary Fund. The purpose of it is to help stabilize international banking system, okay, banking system. Otherwise, you know, as I said before, we need some orchestrator, okay, who can work out so that the exchange rates and those kind of exchange rates should be stable, so that we could do trades and do a lot of economic activities with other countries, right? So IMF has been there, and then their purpose is to also help the government to have sound fiscal policies as well as monetary policies, and some of that concepts related to IMF is special drawing right, SDR, right? That's a kind of a reserve. They say it's artificial currency, okay, special drawing right. You can see it in the textbook, right? SDR, right? In the IMF, right? And then that's kind of for IMF, right? IMF, it has hundreds and hundreds of member central banks, right? Member countries, and then these member countries, well, depending on their participation, and then which means their economic size, GDP size, right? Depending on their participation on this IMF in terms of monies, right? They get some special drawing rights, which works as a reserve, okay? So much so that when a country is in trouble, they can draw down from this special drawing rights as if it is a currency, okay? It's a artificial currency, which is a basket of 5 different currencies these days, which is US dollars and euro and British pound and Japanese yen and Chinese yuan these days, right? And then the SDR, every member countries have their own SDRs, but they have different size of SDRs, right? So US must have the biggest portion, and Korea has a very small portion, I guess, and things like that. So SDR, later you will see this balance of payment accounting is going to be treated as just like foreign currency reserves. Korean balance of payment, for example, for Korea's balance of payment, you not only have US dollars as currency reserve, and then gold as a reserve, but also you have SDR as a reserve, okay? So that's basically the idea about the SDRs. Now, balance of payment accounting should be discussed, okay, finally. And then in balance of payment account, we have the concepts of current account and capital account and statistical discrepancies and official reserve account. After going through this class, I want you to be able to explain all these things yourself, all right? And then we're going to talk about the balance of payment identity, and then balance of payments trends in major countries. Now, before we move on further, there are some concepts, okay, as a refresher of your macroeconomics 101. Balance of payment, familiar words? Yes, in terms of in Korean language, this is 국제수지. I don't know how to pronounce it in Chinese. 구어지, 수지, or something. I don't know. 수지. And then current account balance is something called 경상수지 in Korean terminology. 찡창 수지, 수지, I don't know. And then trade balance is 무역수지. which is in Korean terminology. Don't ask me in Chinese. And capital account balance, which is something called the 자본수지, right? Foreign currency reserve is what we call 외환보유고 kind of things. And surplus and deficits, okay, you have to familiarize with these kind of jargons, okay, throughout this semester. 흑자 versus 적자 kind of things. And GDP, export, import, right? Sounds familiar? And then flow concept and stock concept. You remember those things? Yeah. So those things we're going to discuss. And then balance of payment accounting, right? This is the statistical record of a country's international transactions over a certain period of time, presented in the form of double entry bookkeeping. Note that when we say a country's balance sheet of payments, we are referring to the transactions of its citizens and governments, corporate citizens as well as individual human citizens, right? And those government, okay? And then a period, yeah, of course, usually 1 year basis, right? And then double entry bookkeeping, what is that? That's 복식보기 in Korean terminology, right? Debit and credit, and you have both columns over there, and then they have to balance each other out somehow. You remember that? Yeah. That's gonna show up, okay, and bother you. Balance of payment, double entry bookkeeping, yes. You have to be refreshed about your accounting 101, very basics only, okay? So, let's see. Remember these things, right? Debit and credit. And balance sheet, okay, balance sheet. What did you have in your debit? That you had assets, and credit you had liabilities and equities. Remember? It seems like it is too much light over there, right? Let me expand this window a little bit. Yes, debit and credit, and liabilities and equities that you see, right? Good. And income statement, okay? What did you have? In debit, you have expenses or costs. And credit, what did you have? Revenues or incomes, net income or operating income, all these kind of things, right? The basic idea is like whatever goes out of your pocket and whatever comes into your pocket, okay? Debit out of your pocket, credit into your pocket, okay? That's that. Debited means subtracted, credited means like added, okay? Why is that the case? After doing all this income statement work, you get net income, and then you pay dividends out of it, and then the remaining part goes into the equity, right? So this is the way I understand it, right? As debit and credit, asset, liabilities, equities, expense and revenues. Good? In Korean terminology, 자산, 부채, 자본, 비용, 수익, right? Good. So that's how we understand it, right? Now, how can this thing help us in balance of payment or the country's transaction, okay, country by country transaction, okay, summary, right? It's going to be about this part, okay? It's going to be about this part. Something goes out of Korea or your country, something that comes into your country, okay? That kind of things, right? There's some expenses, okay, out of the currencies, and then into, okay. That's going to be basic idea about it. And then we're going to use the intuition about this balance sheet as well, because in balance sheet, what did you have over there? Well, balance sheet, you had current assets, current liabilities, and then fixed assets, and then long-term liabilities and equities over there. Okay. The distinction between these two, current versus fixed, was like, and then current versus long term, okay, was like something maturing within 1 year, okay, and some liquid asset, right? Whereas something maturing after 1 year, long term, and this one as well, more fixed assets or intangible assets, right? That kind of things. So similar thing will go on in balance of payment accounting. In what sense? Well, balance of payment account, you first have what? Current account, and then capital account, okay? Which is going to be, let's see, is it too shiny over there? So let me wipe it off. Um, uh, Current account, and then capital account. Okay. In your balance of payment, which has to do with your short-term give and take and long-term give and take, right? But that does not necessarily mean asset versus liabilities thing, okay? And then that will be more like income statement kind of concept will go on. After all, it's going to be balancing each other out. Of course, these two accounts, in theory, they will have to balance each other out so that if you sum it up, then it has to go zero, in theory. But you don't. So you were going to have some statistical discrepancies and then foreign currency reserves that helps you these summing up, right, to be zero. Okay, let's go to that one a little later. For one example, let's consider this kind of hypothetical transaction. Okay, import-export across the Atlantic Ocean. Okay, here is Atlantic Ocean, and you have USA and UK, okay, British versus United States, and then in US you have Maplewood, the importer, okay, import, and then in the UK you have Queen, a company, okay. Why Queen? Because this is a bicycle manufacturer, right? Bicycle, bicycle, bicycle. I want to ride my bicycle. Yeah, I want to ride my bike. This kind of things, right? Goes on over there. How many of them? I don't know. But Maplewood imports this bicycle and pays, okay, 100,000 US dollars. Okay. Of course, they would pay it in British pounds by going through FX spot market through their bankers, right? So they will convert this amount into certain amount of, let's say, the exact amount is right now not important, but FX market using the conversion rate. Let's say you will go to a certain British pound amount, okay? And how does it appear in the balance sheet of Queen? It's going to be cashing in, right? So that's going to be what? Debit or credit? Debit or credit? Credited, right? So there will be X amount of sales, right? And which this has to balance out somehow in their book, right? In their bank account, okay? Which in their bank account of right, or they will use to. I mean, here they will be debiting $100,000 debited out of their deposit of Y dollars. They must have some. They must have had some big amount of deposits enough, and then they had to cash it out, 100,000 US dollars, and then convert it into British pounds, and then send those things to Queen. So all that I'm trying to say is that what's that? There will exist a $100,000 credit recorded by Queen. Okay, $100,000. Of course, in this statement, it's not assuming it's just bypassing this FX transaction, but we are assuming $100,000 US dollars of sales, okay, instead of going through this. But the whole idea is this, okay, $100,000 showing up as a credit should be matched with $100,000 debited in the importer's bank account, right? They have to balance each other out, okay? So, which is consistent with the idea of double entry bookkeeping, and it helps us our understanding about the balance of payment, okay? Accounting for the country level, country to country, okay? Even though this example, I gave one name of the companies, but essentially they belong to one country and they belong to another country. So country by country level, you can summarize all these transactions or aggregate all these transactions in a double entry bookkeeping manner. And this transaction of import, okay, will lead to a rise in supply of dollars and the demand for British pound. Because as I said before, if you introduce this FX market and then this is British guys, right? So we have to convert it into British pounds. They only accept British pounds in this example, for example. Then you'll have to convert it. But that conversion, your demand for British pound will increase to satisfy this guy, and supply of US dollar will increase because of the payment, okay, that you have to make. Now, balance of payments. The balance of payment accounts are those that record all transactions between the residents of a country and the residents of all foreign nations. So they are composed of the following, which is the current account, the capital account, the official reserves account, and statistical discrepancy. Here's an example in the textbook. One interesting thing in this textbook is textbook authors are not accounting guys, okay? Which is good because I'm not an accounting guy either. But one symptom of that is that their debit and credit columns are flipped over here, okay? Credit comes first and then debit comes next, which may screw up your mind a little bit, but don't get confused, okay? The whole idea should be the same. The debits column should have been on the left-hand side, okay? So what you see, okay, in this table is that in current accounts, okay, your exports, okay, what you exported, okay, that comes into your credits, just like this guy over here, UK Queen, bicycle, I want to export my bicycle, that comes into my credit. And then for the importers, that should be your debit, okay? So that you see number 2 imports, those are showing up in debits, okay? They, for your convenience, they are just showing it with negative sign so that you will not get confused, okay? Just sum everything and then you'll get balance later on. That's the idea, okay? Import, export, right? Export on the credit and then import on the debit, okay? Just like this bicycle example, right? And among those imports and exports, what kind of do you have, right? Merchandise, import and export, this bicycle case, right? And then service is what? Well, consulting business kind of things, right? Or and then factor income, what are those? Well, this is related to your foreign direct investments or portfolio investment, I should say, portfolio investments, right? In your capital account, okay? What is this about? Factor income. For example, if you invested in foreign treasury bond, okay? Foreign treasury bond, debt securities, Well, Treasury bond gives you what? Interest income, fixed income, right? That interest is one kind of this factor income. And also, if you invested in, let's say, foreign countries' stock, let's say me as a Korean invested in what kind of companies? Let's say ExxonMobil, right? Then they may pay some dividends. I don't know how much dividend they will pay this year because of the screwed up economy. But if they pay any dividend, then the dividend receipt that I got, right? Dividend that I received should be factor income, okay, in the balance of payment account of Korea, okay? Right. And then unilateral transfer, what is that? It's like a help, okay? 원조, in Korean terminology, 원조 kind of things. What is that? The giving money just out of your goodwill kind of things, right? Not in return for any other things, right? But charity donation kind of things, right? To poor countries, that kind of things should be your balance, what's that, unilateral transfer. Now, the balance on current account is the summation of the above three: exports, imports, and then unilateral transfer. I said summation, even though import is a subtraction amount. So you aggregate all those things, it will just cancel each other out. That's why it is shown as a minus sign over here. Okay, minus sign plus it's minus. Okay. Capital account, well, that's about a long-term thing. Okay, long-term thing. What do you mean? Direct investment, foreign direct investment. For example, if you purchased a factory or building some factories over there, a production facility. Hyundai Motors built factories in Alabama, and then Samsung built their manufacturing facilities in South Carolina, and then together with Volvo and Boeing, right, kind of like all these kind of production facilities, right? This is direct investment, right? And then portfolio investment is this purchasing stocks or bonds, okay? Stocks or bonds, usually this like financial purposes, okay? Financial investment. And then the derivatives, right? 파생상품 in Korean terminology. Call options or put options or all kinds of exotic options, right? Other investments, well, miscellaneous ones, other investments, just lump it over there. And then adding all these item 4, 5, 6, okay, then you will get the balance on capital account, right, which is more long-term things, fixed asset related kind of things, you can think about it. And then the last item is statistical, two items still left, statistical discrepancies, and then official reserve account, right? In fact, official reserve account, okay, is first given to you, and then statistical discrepancy is something you solve for, okay? After doing all these numbers, this is the X or unknown that you have to solve for. What is this about? Well, this is the balancing, right? This is a record, statistical record of all the transactions of a country. There must be trillions of bazillions of transactions going on, okay, in a year for a country. Can you, when you aggregate all those things, do you think really it will balance each other out exactly? So much so that when you add current account balances to capital account balances, right? Then would you get zero exactly? And the answer is no. Okay, a lot of missing part will be there. Okay, errors will be there. Transaction record errors or kind of all kinds of things may happen. Okay, inaccuracy may happen. So the inaccurate part, right, that has to be filled is called statistical discrepancies, right? This is a plug figure in English terminology, right? So we're going to go through that part later on. Okay, so current account, okay, this includes all import and export of goods and services. includes unilateral transfers of foreign aid. Okay, if the debits exceed the credits, then a country is running a trade deficit. And if the credit exceeds deficits, then the country is running a trade surplus. Okay, 무역 적자 versus 무역 흑자 in Korean terminology. Now, capital account measures the difference between the country's sales of assets to foreigners and the country's purchases of foreign assets. So FDI, foreign direct investment, can go either way. My country invests more into your country. Sometimes your country invests more to my country. That kind of things happen, right? And then in the United States, the U.S. enjoyed a $188.9 billion of capital account surplus. Absent of U.S. borrowing from foreigners, this finances the U.S. trade deficit. Usually, you will see it later, again and again. U.S. has been experiencing a huge amount of trade deficit, current account deficit as well, right? How can you survive with that kind of deficit? In mercantilist ideas, that's bad. But how could you, right? Because the U.S. has drastic amount of surpluses in capital account. Okay, you're going to get there. And then capital account is composed of foreign direct investment, portfolio investment, and other investments. Then statistical discrepancy. There are going to be some omissions and misrecorded transactions. I said errors, kind of things, right? So we use a plug figure to get things to balance, right? Right, and then here's just one example of current account, okay, balance, and then capital account balance and official reserve account, and summarize like that. Now, right, yeah, right. So same thing summarized in bigger sized fonts. Anyway, the official reserves account. This official reserves assets include gold, foreign currencies, and SDRs. What is SDR again? Today's lecture I told you about IMF special drawing right. Okay, go back to that part and then listen to it. And then reserve positions in the IMF. Okay, it's essentially it's IMF. They have two kinds of reserves, I guess. One SDR and the other reserve positions. Anyway, it's not important, but foreign currencies reserve is more important, okay? Now, the balance of payments identity works like this. The balance of current account plus capital account plus the reserves account should be equal to 0. In theory, under pure flexible exchange rate regime, then the balance of current account plus capital account should be equal to 0. Okay, there should be no errors, and then completely flexible exchange regime. You don't have to worry about currency crisis, so that you don't need to have that reserves or anything, right? Foreign currency reserves. So these two things should be perfectly balancing each other out. But in reality, if you don't have foreign currency reserves, it's just like in Korea. Okay, you're in trouble. Okay, you're going to hit financial crisis, and IMF will knock the door. Bum, bum, bum. Mr. or Mrs. You're in trouble. Okay, how do you say? Bailout funding. Okay, I'll give you bailout money, and you listen to me. They will come and bother you. Anyway, right. So the U.S. balance of payments in 2015 is summarized again, right, over here. And then balance of payments on current account. Debit, we see debit of $463 billion, okay, which is your import, okay. In the U.S., the United States imported more than it exported, thus running a current account deficit of $463 billion, right? Right. Did I say import? No, this is net import. I should have said it. Okay, sorry. And then balance of payments on capital accounts, right? FDI kind of things, or portfolio investments. Well, in the US, they had balance of on capital accounts of $188.9 billion. During the same year, the US attracted net investment of $188.9 billion. Clearly, the rest of the world found the US to be a good place to invest, either in portfolio or sense or in FDI sense. Okay, and wait. Now, US balance of payments, the balance, right? You add those two things, current account and capital account balances, and you still have minus number 270 something. Under a pure flexible exchange rate regime, these numbers would balance each other out, but it's it's not the theory world, it's a real world. So you see discrepancy, and statistical discrepancies in this year for the US turned out to be $267.8 billion. In the real world, there is a statistical discrepancy like this every year. And the US balance of payments identity works like this, including that the balance of payments identity should hold like this. Your balance of current account plus balance of capital account plus statistical discrepancy should be equal to minus of your reserves. What's that? Foreign currency reserves, right? So 463 plus minus, right? Negative 463 plus 188.9 plus 267.8 should be equal to negative 6.3 billion US dollars, right? So that's what we observe over here, negative 6.3 billion US dollars. Now, let me move on to the next one. Balance of payments and the exchange rate. Well, the exchange market, if you think about it, right? Two different currencies converted to each other, right? Foreign exchange market, you can think about it as a supply and demand, right? Supply and demand for each respective currency. As U.S. citizens import their supplied dollars, they supply dollars to the forex market. As U.S. citizens export, others demand dollars at the forex market, right? So this is a demand and supply, right? Along the line, right? You can see it. And when it comes to U.S. government's expansionary monetary policy, okay, when the U.S. government sells dollars, right? Okay, did I say expansionary? No. When the U.S. government sells dollars, the supply of dollars increases. When the U.S. government is when the we can think about this exchange market using the supply and demand curve, okay, just like your intuition in the economics 101, okay. As U.S. citizens import, just like this bicycle example, right? They supply dollars to the FX market. On the other hand, as U.S. citizens export, okay, others demand dollars at the FX market, okay. So that's in the market you will see equilibrium price happening where the supply meets demand and the market clears, right? Now, interesting thing is sometimes the U.S. government massively could intervene in the market so that they could sell U.S. dollars to make it cheap for whatever reason it could be. Well, when could it be? When you want your export products to be more price competitive, right? You want your FX dollar, currency value to be depreciated a little bit, so that they can, the U.S. government can intervene and push more dollars into the FX market. In that case, the whole supply curve shifts to the right in a massive scale, so that you will see the equilibrium price decreasing. Okay. Sovereign wealth fund is one important players in this FX market these days, and then government-controlled investment funds are playing an increasingly visible role in international investments, not just in the FX market, by the way, foreign direct investments, portfolio purposes, or FDI kind of things, right? Sovereign wealth funds are mostly domiciled in Asian and Middle Eastern countries like, United Arab Emirates, right? Abu Dhabi or kind of guys, right? And usually are responsible for recycling foreign exchange reserves of these countries swelled by trade surpluses and oil reserves or revenues, right? Sovereign wealth fund. Well, two countries hit my mind: Singapore and Korea. Singapore, they have two big entities, which are Temasek and GIC. And GIC is like a government investment corporation, and they are the ones precisely working with these foreign reserves of their country. And Temasek often appears in Korea's stock market as well. They are basically based on this Treasury. Okay, you see that difference: foreign currency reserves versus the Treasury. The central governments, sometimes they are left with some extra money, okay? Budget surpluses. They don't know what to do with this. And then they maybe, it's better to invest in a portfolio investment fashion in the outside the countries, right? So some of these Korean big corporations, like we call it chaebol, significant shareholders, right, turns out to be Temasek sometimes, okay? Very interesting phenomena going on. And then Korea also learned from this, and then or learned from Singapore, I guess, maybe. So that's they created Korea Investment Corporation. Sounds very similar to GIC, okay? And then this is working with this Korea's foreign reserves, right? Now, talking about the exchange rate and import and export and current account deficit versus surplus. Okay, how does a depreciation of a currency affect the trade balance? Can be an interesting question. Okay, now here's a J curve because it is shaped like a alphabet J, as you see in the red line over there. What you see in the vertical axis is the change in the trade balance, right? Trade balance, 무역 수지 적자 흑자 in Korean terminology, right? So the above the line, above the horizontal line is surplus, and below the horizontal line is deficit. Okay, trade balance, right? How does it get affected over time? What you see on the horizontal line is timeline, right? So red one shows the trade balance, okay, over time. Following a currency depreciation, the trade balance may at first deteriorate before it improves. For example, today Korea's FX rate, okay, Korean currency depreciated against US dollars, right? If it were not this kind of crisis situation, but the usual trading situation, and then we had this kind of this depreciation of the currency, surprisingly, then what happens is that in the product market, Korea will have a trade deficit in the short run because immediately there's nothing we can do about the import price, right? It is imported in the US dollar terms, but US dollar is appreciated against Korean won, so that import price high but export price low, so much so that in the short run we're going to suffer some trade deficit amount. But in the long run, what happens is that Korea's export products get price advantage, okay? Cheaper, it could be sold cheaper. For example, Samsung's semiconductor or cell phone, okay, could be sold even cheaper than right now, so that they may beat Xiaomi or like Huawei, so that they will have better revenues later on. so that in the end they may have surplus, trade surplus. Now, as an example, consider an imported good for which there is no domestic producer. If demand price is inelastic, then following a depreciation, the trade balance gets worse until domestic production begins, right? So it also depends on the price elasticity of that product. Now, balance of payments trends are shown in the following table that you're going to see. And let's see over here. Right, 3 different countries will be shown: US, Japan, and China. And then, since 1982, the US has experienced continuous deficit on the current account and continuous surpluses on the capital account. During the same period, Japan has experienced the opposite. So they were the major exporters to the United States. That's why. Recently, it's China. The US and the UK tend to realize current account deficits, whereas China, Japan, and Germany, and perhaps Korea, tend to realize current account surpluses. This global imbalance implies that the US and the UK generally use up more outputs than they produce, while the opposite is true for China, Japan, and Germany, and Korea. Now, you see this chart over here, okay? What you see on the vertical axis of each table is the trade, what's that? Balance of payment trends, right? Current account, right? Current account balance, surplus versus deficit, okay? Current account or capital account, surplus or deficit. And then the current account is shown with the black line, and the capital account is shown with the blue triangle, the dots line, okay? Now, as I said before, right, the capital account, okay, of the US has been a surplus for a long time. The current account has been in a deficit for a long time, okay, until 2015, and it is even more so these days, right? Who are they importing from? Well, Japan and China, and Germany and South Korea, and then other countries, I guess. And then especially Japan, you see the current account has been always in the surplus, okay? And then China also, their current account has been always in the surplus. They were exporting much more than they import from the United States, okay? Toyota Motors, you can think about it, or Huawei these days. And then you may wonder, right? How could you sustain in the mercantilist sense? Oh, the United States economy is not sustainable that way. But it's not all that way, okay? The thing is, there is the capital account, which is you can host more foreign direct investment, or maybe you have more attractive portfolio investment opportunity in your country. For example, US Treasury, okay? So what Japan did and China is doing, okay, is that they want to keep their currencies at competitive foreign exchange rate level. How to do it? Well, buy into that US Treasury, okay? The demand for US Treasury will go up, and then the US dollars will keep strong, okay? And that results in a capital account surplus in the US market for a long time, okay? And so with that, there a lot of Japanese money and Chinese money has come into the US Treasury market, right? Now China is the biggest holder of US Treasury, because some people say, well, like Niall Ferguson, they say, this is the world of Chimerica, which means China plus America in this relation, right? Because China holds such a huge amount of security, US Treasury, so that they're closely intertwined with the US economy. Some people say, what if Chinese government decide to sell off, fire sell all those US Treasuries, and then which will tumble down the value of US Treasury value, right? But they can't, because it will screw up the China's own portfolio value. Okay, you don't want to kill yourself, so they become one body. Is kind of right a mixture of two countries. That's the concept of Chimerica, but we don't know. Okay, when it comes to national interest, how much China will become more hostile and then willing to suffer all kinds of negative consequences. We don't know. Um, we hope that doesn't happen for neither country. Anyway, so that's what we see it. Mercantilism and the balance of payments are shown over here. Okay, so mercantilism is like in Korean terminology, 중상주의, right? 중상주의. It holds that a country should avoid a trade deficit at all costs, even to imposing various restrictions on imports. We call it beggar thy neighbor policy. Okay, I want to be rich at the expense of you, and just that's the idea of mercantilism. 19th or 18th century European empires were competing in this sense. Mercantilist ideas were criticized in 18th century by British thinkers, for example, Adam Smith and David Ricardo and David Hume. They argued that the main source of wealth of a country is its productive capacity, not its trade surplus per se. Okay, so you can provide some better FDI opportunities, right? So mutually it could be beneficial, right? So that was their idea. And the table over here shows top U.S. trading partners in 2015. By far, that's China, the biggest trading partner. The trading partner, how do we calculate that? Well, import amount plus export amount. Okay, that's total trade. Okay, total trade. So, in terms of total trade amount, China is the biggest partner of the United States. The next is Canada, and then the next is Mexico. Clearly, you see why NAFTA has been there, right? Canada, Mexico, and the U.S., they are closely bound to each other. And Japan comes next, and then Germany is the fifth, and there is South Korea, number 6, and it's higher than United Kingdom these days, and France, and Taiwan, and India, and Italy, and Brazil, Netherlands, and Belgium, and Switzerland goes down there. Very interesting table. But it's even more interesting to see this colorful table over here. Okay, this is visualized macro data coming from Harvard University. Now let me take you to that website over here, which is Atlas CID harvard.edu. And then let me see, for this site you can have a lot of macro trade relations shown in very visually colorful manner. So it seems like it's not showing up. It's Microsoft Explorer takes a long amount of time. Where's that? Atlas CID Harvard. Okay, there we go. Please bear with me. It takes a little bit of time, and it's extracting the data of Germany. Germany is trading. Anybody from Germany, right? Hallo, wie geht es Ihnen? Right? Yeah, right. Jawohl. Hey, how are you? Right? So trading partner, well, this is a breakdown of export of Germany by the importing partner. So who is the biggest, where did Germany export to in 2017? You can see it, okay? United States of America, like about 9%, and then France, neighboring country, and then China, about 6.8 percentage point. Where's South Korea? Over here, 1.3%. Now, you can switch this into import. Does Germany import from any countries? Yeah, France over there, they must be, I don't know, importing a lot of wines, I guess. And then China, yeah, 9.33%. And how about Korea? Yeah, 1.03% over there. And then if you click those things, you can see a breakdown by the product or something like that. And also you can switch into different countries. For example, can I see the USA, yeah, here you are. All right. And then where did the United States of America import from in 2017? Pretty much China, and then Canada, Mexico. And an interesting thing is, where's that Hong Kong, right? Yeah, Hong Kong is down there, right? Or you call it Hong Kong SAR. Yeah, okay, fine. And then, in contrast, how about export of the United States? You can click it and see it, right? To Canada and Mexico by predominantly, and then China as well, like that. So visually, you can see in one shot, okay, how the countries are doing export and import by the countries and by the industry as well. You'll see it if you play with it. Now, where were we? Right. Yes. And then summary, right? You can read it. The summary is over there, and then move down to appendix, okay, of chapter 3. Chapter 3. All right. This appendix is a connector between your macroeconomic understanding about GDP and then the balance of payment accounting, right? How is the GDP related to the current account deficit or surpluses? And then what's the implication to the savings of the country or investment of the country, or government spendings or tax revenues kind of things, right? How they are interrelated. Okay, we're going to look at it. Now, let us start with this national income accounting. Okay, national income, that's national income, which is GDP, gross domestic product, okay? That should be consumption plus investment plus government spending plus export minus import. The way I understand it is this way, okay? The way I understand it is, hello, I'm growing bigger. Yes. Now, let me use this one. Equal sign, right? Here, consumption, whatever you consume and whatever you invest, right? And then government spending plus export, okay? Should be based on what you produce, GDP, okay? Whatever you produce, you consume, and then governments also consume, and some of the consumptions go to outside country, okay? And leftover or some okay, you reinvest for your country's growth, right? Or your company's growth, right? Reinvestment kind of things. But GDP is not all. Sometimes you have to import to consume, right? So that's why we have GDP, which is why in that note that you saw, CIG plus X minus M plus plus. This guy on the other side of the equation, like this. Can you see it? Hello. Right, I have to do it this way. Okay? Right. Right, this. So this is what you see in the formula over here. What you produce plus import. What you produce and import is what you consume and government consume and then export to the other countries plus your investment. Okay, that has to hold every year. Then what kind of what do we want, right? The thing is, private savings is defined. Okay, let's bring in the savings and tax. Okay, savings and tax. Private savings is defined as the amount left from national income after consumption and taxes are paid. So savings should be what? Um, your GDP minus consumption minus tax, right? So what you produce after eating and after paying tax, whatever is left over, you save to the bank. Okay, that's the idea. Now, the thing is, you have y over here. Okay, you have, let me see, expand it again. Hello, right? Um, you have y here. So stick it in. Okay, and that tells me that your savings is nothing more than C plus I plus G, our spending plus X minus M minus C minus T. Make sense? Minus C minus T, right? So what do you see? Cancel each other out, okay? Cancel each other out. And we have some common items that we want to group together. Okay, common items. The one, okay. Government spending and tax revenues. They are closely related, right? And then savings and investment. Okay, right? They're gonna get together, and export and import. They're gonna get together. Okay, so in the end, what you're gonna see is I'm gonna bring it to the upstairs over there, which is um, savings minus, if you bring this guy to the other side of the equation, right? Looks like this, and then plus tax minus government spending, okay? And then should be, right, equal to what? Export minus import. Make sense? Yeah. So these guys become this, right? And then just fold it into parentheses like this. What you see over here, this guy is our good old friend, balance of current account. Okay? Balance of current account. Now you can explain your balance of current account with respect to two big items over here. Okay? Your government spending versus tax revenues, and then savings and investments. Okay? Private sector, government sector. Okay? That determines your balance of payment, balance of current account. Okay? Now, so, right, this shows that there is an intimate relationship between a current country's balance of current account and how it finances its domestic investment and pays for government spending. If the savings is smaller than investment, then a country's domestic savings is insufficient to finance domestic investment, right? Similarly, if tax revenue is smaller than the government spending, then the tax revenue is insufficient to cover, right, those government spending, and the government budget deficit exists, right? So all these things add to the current account deficit. When current account is in deficit, government budget deficit, and part of domestic investments are being financed by foreign controlled capital. So that's one thing you have to notice. And then to reduce balance of current account deficits per se, one of the following must occur. For a given level of savings and investments, the government budget deficit must be reduced. This is what the IMF was enforcing to South Korea and then the troubled countries before. And for a given level of investment and then tax minus government spending, savings must be increased, right? If you don't save, right, how could you build up your current account surpluses, right? That's the intuition. For a given level of savings and the government spending and tax amount, investment must fall, okay, to reduce the balance deficit, right? Because investment is something good for production later on, but immediately this is spending out of your pocket, or the cash going out of your pocket. Okay, current account gets hurt. So that's why. But rather, I would say increase the savings, right, instead of touching upon this investment. That's primarily what we do. Okay, so this is the end of the fourth week of lecture. I hope you enjoyed it, and I will assign some homework problems to you. So take a look at it, and then give me if you have any questions. By the way, email me your questions to this email address over here, which is, can you see it? AYHKIM at skku.edu. Right? As I said before, A, Andy, Y, Young, H, Han, Kim, right? At skku.edu. All right. See you next week. Bye bye. 再见. Tschüss. Or au revoir.